Hello, I'm Regina McCann-Hess, president of Forge Wealth Management, and welcome to our Women and Wealth series. Today, we're going to talk about minimizing taxes with estate planning and gifting. Now, a comprehensive estate plan that includes gifting can ensure your wealth is transferred according to your wishes and help you manage your estate tax bill. Estate tax and gifting rules are obviously pretty complicated, and this overview is only going to cover a few of the many issues to consider. But at least what it should do is have you think about it, have you make an appointment with your financial advisor, your tax advisor, your estate planning attorney, so that they can assist you with a design of an estate plan that fits your specific needs. One of the first things we're going to talk about is reducing estate taxes by giving annually. Under the current 2022 tax law, individuals can leave their heirs up to $12.06 million without federal estate tax liability. A taxable estate greater than that 12.06 million may actually be subject to estate tax at graduated rates up to a maximum of 40%. So that's a big deal, right? Now, gifting not only allows you to share your wealth with your loved ones during your lifetime, you kind of get to watch them enjoy it. It also decreases the value of your estate, which may reduce any estate tax your estate may have to pay after your death. So in 2022, each taxpayer is allowed to give a maximum of $16,000 per recipient to as many people as he or she chooses without any gift tax ramifications. So that actually translates to a married couple being able to give $32,000 to each individual. For example, if you have 4 children and 3 grandchildren in 2022, you can give $16,000 for a total of $112,000, or together with your spouse, you can give a total of $224,000. The amount of this annual gift tax exclusion is subject to change each calendar year. However, in any one year, you may give as many people as you choose gifts up to that year's annual exclusion without gift tax liability. A very well used idea. Next on our list is to know your lifetime total taxable gift limit. Gift taxes are based on all property transferred throughout your lifetime. In 2022, each person has a lifetime gift tax exemption of $12.06 million, right? We already talked about that. Now, not only are gifts that fall under the annual exclusion exempt from gift tax in the year they are made, they are also not included when adding up the lifetime total of gifts given. So it's kind of like a gift that keeps on giving, right? So gifts above the annual exclusion limit are considered taxable gifts, and they do require the filing of an IRS gift tax form. These amounts are also applied to the lifetime exemption. However, you will not actually pay any gift tax until your lifetime gifting total is greater than the 12.06 million or the applicable limit in the effect at that time. In addition, gifts to your spouse or to charity generally are not taxable. Okay, next we're going to talk about college gifting options. If your goal is to pay for the future college expenses of your children or grandchildren, you may want to consider using your annual gift tax exclusion to establish a 529 college education savings plan. You also can use the unique accelerated 5-year gift feature of a 529 that makes a combined gift of up to $80,000 or $160,000 per married couple to each beneficiary. Now, this falls under the $16,000 a year tax-free limit as long as no additional gifts are made to that beneficiary for 4 years after the year during which you make the one-time gift. However, in the event of your death before the end of the 5-year period, a pro rata portion of the gift will be added to your estate for estate planning or estate tax purposes. Now, here's another option. You can make payments directly to the qualified institution for tuition. You can also do that for any healthcare provider for medical expenses on behalf of somebody else without those amounts being subject to gift taxes. So basically, when you're paying for someone's college tuition and you're like literally writing the check right to the bursar's office, the financial office, or you're paying a medical bill directly to the medical care provider, that does not fall into the gifting arena. It's excluded. So again, just the gift tax exclusion for tuition and medical expenses is in addition to the annual exclusion per recipient. Okay, next on our list is using the unlimited marital deduction. The IRS provides special tax considerations for spouses under what is called the unlimited marital deduction. Any amount may be transferred to your spouse during your lifetime or at your death. Now, the other thing is you're not going to incur either federal gift or state taxes, providing that both parties are U.S. citizens. Now, if one is not a U.S. citizen, there are different rules that apply. So we're just talking about couples that are both U.S. citizens. In that case, any further taxes that might be due upon death of the first spouse can be avoided by leaving all of the estate to the surviving spouse. Next up for discussion is the taxable advantage of charitable gifts. Now, gifts to charities generally are not subject to gift taxes. Lifetime charitable donations also have two other advantages. They're eligible for income tax deductions and can reduce the size of the donor's estate. So charitable bequests made upon death via a will or specially designated trust may also generate estate tax savings. For example, let's say Joe and Sheila Smith each have 12.06 million in separately owned property. They don't have any children and wish to leave as much money as possible to their favorite charity. So when Joe dies, he could give all of his property to these charities, and there would be no federal estate tax due upon his death. Sheila could continue using her assets for her support and then leave the remainder to the charity, again, avoiding any estate taxes. Alternatively, Joe could leave everything to Sheila and have no estate taxes because of the marital deduction. And then when Sheila dies, she would leave all the remaining property to the charity, and her estate would get the full deduction. Next topic would be the value of trusts in estate planning. Irrevocable trust can be a valued estate planning tool that may produce substantial estate tax savings. Trusts are generally designed to hold life insurance policies, can help keep the proceeds from the policies out of your estate. Other types of trusts can accomplish different objectives, such as facilitating charitable giving or effectively combining the use of the estate tax exemption and the unlimited marital deduction. Well, I threw a lot out at you here today, but a couple key points just to remember. In 2022, taxpayers are able to gift $16,000 per individual annually that would be tax-free. No gift tax return filing is required on the annual gifting allowance. Also, no gift tax has to be paid until your lifetime total taxable gifts exceed the applicable exemption amount. And of course, gifts to a spouse are generally not taxable. Thank you so much for joining me today. Again, I'm Regina McCann Hess. My website is forgewealth.com. You can follow me on Facebook, Twitter, and YouTube at Forge Wealth, and on LinkedIn, I'm Regina McCann Hess. Have a great day. Thanks.